Weekly with your host, Jerry Robinson.
Welcome.
Not just some guru.
Oh, really?
Your host is an economist and a best-selling author.
What an interesting news item. I better write that down.
And just someone who likes to make money and help you to make money. Welcome to Follow the Money Weekly. And here he is, Jerry Robinson.
Friends, welcome to this week's edition of Follow the Money Weekly Radio. So glad that you're joining us all around the world. You can find us online at followthemoney.com. Followthemoney.com. That's right there where you can find all kinds of free podcasts, videos, articles, charts, things we've done over the years to help you understand the economy and understand money. But today we have a really good show lined up for you. I'm going to be joined by a very popular economist, best-selling author, and the CEO of Euro-Pacific Capital. His name is Peter Schiff. He'll be joining us to talk about the current stock market rally, the latest Fed decision, the FOMC's decision this week to raise rates by 25 basis points. And we'll also talk about the Trump administration, where Peter sees the Trump administration going in 2017, if he's still a fan of the Trump administration, all of that straight ahead. We'll also be joined by Tom Cloud with an update on precious metals. So, without further ado, let's just dive right in to my interview with popular economist Peter Schiff. All right, well, joining us on the line today is popular economist, author, and Euro-Pacific Capital CEO, Peter Schiff. Peter, welcome back to Follow the Money Radio.
Well, I'm glad to be welcome back.
Great to have you. All right, so a lot has happened since you were last on the program, and in fact, just this week, earlier this week, we had the Federal Reserve make their announcement. It was very much what everybody had pretty much expected, a 25 basis point rate hike, the third in the last decade. What's your takeaway from the Fed and the Fed language that we saw this time? Obviously, the market was goosed by it for whatever reason. What's your thinking on the Fed right now in the stock market?
Well, I think the Fed is only raising rates to create the appearance of confidence in the economy and in the markets. If you actually listen to what Yellen had been saying all along, she said that the rate increases that the FOMC forecast was all contingent on their economic forecasts coming true. That if the economy evolved along the path that they believed, then it would be appropriate for them to be raising rates. Well, it's interesting that since the last time the Fed met, the outlook for the economy has collapsed, at least for the first quarter. The Atlanta Fed in February 1st, they were looking for Q1 GDP of 3.4%. They're now looking at just 0.9%. But despite that rapid collapse in the prognosis for economic growth, the Fed raised rates anyway. And it's not just that data. There's horrible data coming out on resale sales, on personal income. A lot of very weak economic data has come out, yet the Fed has raised rates anyway. And if you actually listen to some of the answers that she gave at her press conference, one person said, what kind of message are you trying to send to consumers? And her answer was, I'm trying to tell consumers that they should be confident in the economy, that the economy is solid. And to me, that was a lie. It was a half-truth because she's not talking to consumers. Most consumers don't even know who she is, and they certainly weren't watching that press conference. She's trying to send a message to the markets, to investors, that the Fed believes that the economy is strong, when they don't. And the way you know that they don't is somebody else asked Janet Yellen a question as to when the Fed was going to begin shrinking its balance sheet. And her answer was, well, we're going to wait until we're confident in the recovery and confident in the economy. Well, if they already are confident in the economy, why don't they start right now? And if they're going to wait until they're confident, that would imply that they're not confident now. So, the Fed can't even get its own story straight. So to me, it's all window dressing. They know this is a disaster coming. We're headed for a recession. We're in a bubble. And they just want to pretend that they're confident so that maybe the bubble will get even bigger. And, of course, when it bursts, they want to have rates higher so they can cut them back down to zero.
Let's talk about that bubble, especially in the stock market here in the United States. And that we have seen, of course, is this optimism, this frothy optimism in the wake of the Trump election. On the hopes of deregulation, we're starting to see that unfold. Also, there's hopes for tax cuts. That's still on the horizon. And also infrastructure spending, of course.
Well,
and so,
of course,
and that's all in the future, too.
Yeah, well, none of this stuff is likely to happen, or to the extent that it happens, it's going to be on a much smaller scale. I mean, first of all, we're broke. The national debt is about to hit $20 trillion. We don't have any money for infrastructure. We don't have any money for tax cuts. I mean, unless we're going to have significant cuts to government spending, we need tax increases. But, of course, nobody wants tax increases. But Trump doesn't want to cut spending. I mean, yes, he'll cut spending here and there. He'll cut some money from the State Department or from the Environmental Protection Agency, but then he wants to spend more on defense or various other areas. And, of course, he won't cut any entitlements, and they're growing on autopilot. He's not cutting interest on the national debt. So the parts of the budget that he's not cutting are much larger and growing much faster than the small parts where he is trying to cut. So government's going to get bigger. The deficits are going to get bigger. So where's the tax cuts? And how are they going to be financed? Where are we going to get the money for the infrastructure? We're not. And all he could do is run up bigger deficits and have higher inflation as opposed to higher taxation. But either way, Americans are going to have to see more of their income go to government, one way or another. And so the market's not going to get this big fiscal stimulus that they think is coming. And to the extent that we get some deregulation, I don't know. I mean, maybe we'll get a little. We'll see. I mean, they can't even get rid of Obamacare. And that was, the big ticket item that they promised. And the only way it looks like they'll get rid of Obamacare is if they replace it with something that looks just like it, only slightly different.
Yeah, I just read your piece on that. You just put out a piece on the Republican replacement plan for Obamacare, calling it a monstrosity. Pretty strong language, yeah.
Yeah, I mean, there is a decent plan out there. Rand Paul and a few other people in the Liberty Caucus, they've got a viable plan, and it actually deals with pre-existing conditions in a way that can make sense, where you have a 2-year window for you to buy insurance with your pre-existing conditions, and I guess we'll have to eat that loss. But once the window shuts, then that's it, because you cannot have an insurance industry if you don't allow the insurance companies to discriminate based on pre-existing conditions. That's what insurance is all about. It's called insurance for a reason. You buy it because you're just in case you need it. But if you already need it because you have a pre-existing condition, that's not insurance, right? If I get into a car accident and then try to buy auto insurance, it's not insurance. I've already had the accident. I'm trying to get somebody to pay for my repairs. I should have bought the insurance before the accident. But, of course, a lot of people want to take a chance that they don't get an accident, so they don't buy the insurance. The only reason that anybody buys health insurance is because they know that if they get sick, it's too late, that no insurance company will sell them the policy. So you have to buy it while you're healthy. But if the Republicans are going to say that it's illegal for insurance companies to discriminate against people with pre-existing conditions, then why would you buy insurance? No healthy person would buy insurance. There's no reason to buy it. And so then you can't even have an insurance industry. But the Republicans cannot even level with the American public. They've already bought into the free lunch that the Democrats were serving. Now they just want to serve it at their own counter. They don't want to take it away. They just want to be the ones to serve it.
It would seem like if you're going to tackle healthcare and insurance and all of this and really make a market improvement, you're going to have to begin with the providers. Do you agree, Peter? I mean, the providers, of course, are constantly ratcheting up the price in the name of free market innovation, in the name of all of this. But that seems not to come up. It's the insurance companies. It's everybody but the providers.
Well, but again, it's just like, why do colleges keep jacking up tuition? It's because the government makes so much money available through grants and loans that there's no real free market checks and balances that exist in other industries. I mean, look, why don't computer companies keep raising the price of computers? I mean, after all, computers get better every year. They get faster. They do more things. Why don't the costs keep going up? Because nobody has computer insurance. I don't buy my new laptop through an insurance company. I shop around. I look for the best deal. And so that's what we need to have in healthcare. We need competition. We need consumers shopping around for the best plans, for the best health care at the lowest possible cost. In fact, if you look at all the areas of health care where there are no insurance companies, look at eye LASIK surgery. Eye LASIK surgery is cheaper today than it was 5-10 years ago. It's better and cheaper. It's still a medical procedure, but insurance doesn't cover it. So the doctors know.
Good point.
Right, the doctors know that there's a marketplace. Same thing with, cosmetic surgery, breast surgery, you want a nose job, all this stuff. People go online, they check out the doctors, they know exactly what it's going to cost. I mean, when you go and you have a nose job, you know exactly what that nose job is going to cost.
That's right.
But if you go into a hospital, you need a gallbladder off. No one has any idea what it's going to cost. You don't even, in fact, even if you ask them what it's going to cost, they can't even tell you. The hospitals don't even know.
No.
But a cosmetic surgeon knows. They put their prices right on their websites. So that's what we need. And the only reason that health insurance got so screwed up in the first place is because of the income tax. What happened was the government made it so that if a worker receives health insurance from his employer, that comes tax-free. But if he receives money from his employer, that's fully taxable. So the government created a tax incentive to get your health insurance from your employer in lieu of wages. And so once that happened, you created this ridiculous third-party payer system. So the simplest solution is just to sever this artificial link between employment and health insurance that the government created. And once you do that, once you have individuals out there buying their own health insurance, just the way they buy their own auto insurance or fire insurance or life insurance, you'll have a competitive market. And, of course, people will use insurance for what it's meant to be used for, a major medical problem. Years and years ago, before the government got involved, if you went to the doctor, you did not, put it on your insurance. If you just went to a doctor for a checkup, you just paid the fee. And if you had a small problem, you paid for it. I mean, you didn't use insurance, take some zits off your face or pierce a wart that was on your hand. I mean, these were simple things. Even childbirth. No one used to pay for childbirth with insurance. You just paid the hospital. It wasn't even that expensive. But now, because everything is paid for by a third-party payer, everything costs a fortune. So once we get back to a system where people pay for routine medical care out of pocket, and when a major problem, you get cancer and you need major, chemotherapy or something, or you need an operation that's going to cost a lot of money, that just like it's like with your car, right? Your insurance doesn't cover your gasoline. It doesn't cover your tires that get worn out. If you need a new windshield blade wiper, or oil change, insurance doesn't cover that. But if you get into a total accident and your car, needs $10,000, $20,000 worth of repair work, well, then you put in a claim. But, so that's what health insurance has to be, and has to go back to the free market. But, they're not doing that. They're trying to keep the government involved, and that's the reason that it's so expensive.
You're listening to the voice of popular economist, best-selling author, and the CEO of Euro Pacific Capital. His name is Peter Schiff. Joining me here on Follow the Money Radio. Peter, let's shift gears here for a minute, go back to the stock market, and talk about where you think we are in this cycle. You said we're in a bubble. The Fed has so greatly distorted the market cycle and everything. I mean, so it's very difficult. But are you imagining that we're getting ready to enter into a period of volatility, or can you see a continuing rise in the stock market throughout the rest of this year? What are you kind of positioning your clients and yourself for as we move into this year?
I think at some point the stock market's going to roll over because it is, priced for more than perfection. It's priced for impossible. And so the market's overvalued. You have a lot of people who have rushed into the market, particularly in the, post-Trump euphoria. And so a lot of people have rushed in and, buy the rumor, sell the fact. In this case, it's going to be buy the rumor and sell because the rumor was false. Because we're not going to get all these good things happening. And I think the market's going to go down. But I do believe that the downside will be limited because I believe the Fed will react to any kind of downside. I don't think the Fed is going to allow the market to go down by 20%. I think before that happens, they will indicate that they're not raising rates anymore. Or they will indicate that they're cutting rates, or they will cut rates, or they'll launch QE4. They'll do something to keep the air from coming out of this bubble. And it's not just the stock market bubble that worries them. It's the bond market bubble. I mean, higher interest rates, scare the Fed. They don't want the long end to really break down. I mean, we start to get the 10-year yield on U.S. Treasuries move above this 2.5%, 2.6, and get up north of 3. And then once that happens, maybe move 4 or 5%. I mean, we can't afford
that kind of interest, even though historically, 5% would still be low. I mean, we can't afford that because we have such an enormous amount of debt that is unprecedented in history. That if we had to pay even a normal rate of interest on an abnormal amount of debt, we couldn't do it. So the Fed doesn't want to bust that bubble. They don't want to crash the real estate market. I mean, there's so many markets that have been propped up based on, all this cheap money. And so they can't risk taking that cheap money away. In fact, just making that cheap money a little less cheap could be enough to do it.
Peter, over at Euro Pacific Capital, whenever you are helping clients and you're putting them in portfolios, curious about the investment selection process. Here at Follow the Money, we're not a investment advisor in any way, but we have been trading for a long time. We've developed trading software, and we use trend trading and technical analysis as well as fundamental analysis as well. But in your investment selection process over there at Euro Pacific Capital, do you use a combination of technical and fundamental analysis? Do you use trend trading whenever you are entering and exiting positions, or is it strictly based upon fundamentals?
Yeah, I mean, it's really more fundamentals. I mean, and now, a lot of the trends are going in our direction, whereas a few years ago they were not. But, I mean, we're trying to invest based on a macro view of the world, of the U.S. dollar, and trying to create portfolios that will protect investors from the inevitable dollar, collapse. So I'm trying to basically get people out of harm's way by positioning their investments in countries, in stocks, and currencies that I think are going to, come out on top when the dust settles. And, sometimes, that strategy is producing better short-term performance than, maybe just buying the S&P 500, and sometimes it's not. I mean, my strategy so far this year is beating the S&P. We beat the S&P last year. So it happens to be working now. Foreign markets and emerging markets, gold stocks are beating the U.S. market, even though the U.S. market is getting a lot of press now because of the rally, the above 20,000. But, of course, my strategy was underperforming the U.S. market for 2015, 2014, 2013, and I think 2012. But before that, from 2011 to 2001, I think we beat the U.S. market every year but one, which would have been 2008. So I think that, since 2001, it has certainly served investors well during this last 16, 17 years to have invested in gold. Gold in 2001 was still below 300. So being invested in gold, being invested in commodities, being invested in foreign markets, both developed and emerging, has been a better long-term strategy than just staying in the U.S. Now, obviously, if you were actively trading, I mean, you could have, if you were doing it perfectly, you could have fluctuated and, made even more money if you did it right and went from foreign to domestic at the right time. Of course, you could have screwed up and got everything backwards, right, and ended up even losing more. It depends on how good you are at trading the timing of the market. But I think that we are positioned now potentially for a huge run in the foreign markets, similar to what we saw from 2001 to 2008, which was pretty much almost all of the Bush presidency. Because, the U.S. market did very well under Bill Clinton, but it did horribly under George Bush. And, the U.S. market did very well under Obama, and I think it will do horribly under Trump. And I think the only thing that will stop a loss, right, the only thing that will keep the market higher when Trump leaves office than when he took office is going to be a highly accommodative Fed, a Fed that's even more accommodative than it is now. And to the extent that the Fed does that, you'll still be much better off being invested abroad just because of the impact of the dollar, because the dollar is going to tank. If we have to go back to QE, the Fed's balance sheet doesn't shrink. Instead, it grows. It goes from $4.5 billion to $5.5, $6.5, $7.5 billion, wherever. We go back to QE. We go back into recession. The dollar is just going to collapse. And that's going to send foreign markets, commodities, gold through the roof.
We are totally on the same page when it comes to investing in foreign markets and commodities. Commodities peaked out in that 2011, rush to the top, and then of course we had that really vicious multi-year downturn in commodities overall. But we seem to have bottomed in 2016, and we have been playing steel producers, copper miners. We've been playing lithium and some of these other, uranium even we caught at the beginning of the year. Do you think that we've pretty much seen the bottom of commodities overall and we're going to begin that next leg up here? It seems like it's looking like that on the charts.
I do, and I think the next leg is really going to start when we kind of break the dollar. I mean, the dollar hasn't gone up much this year or last year. but it hasn't gone down much either. I mean, it's almost all the gains in the dollar happened in 2014, 2015. But now it looks like the dollar has kind of peaked out, and all the so-called good news for the dollar is already out. And at some point, this thing is going to roll over, and we're going to enter a bear market again in the dollar. And that's when the bull market in commodities is going to kick into a whole new leg. Because as the dollar goes down, that automatically creates massive demand for commodities worldwide. And, of course, it also creates economic growth because so much debt around the world is denominated in U.S. dollars. And so as the dollar goes down, that's like a massive tax cut for the world because now the world can repay its debts much more easily, and it can service its debts easier. And so a weak dollar is a big positive for the global economy. It's a rising dollar that chokes off growth outside the United States because it imposes the burden of higher debt costs, higher interest rates, higher principal repayments, and it also, of course, increases the cost of commodities. And so if commodities are getting more expensive because they're not priced in dollars, that decreases demand for those commodities. But as the dollar rises and commodity prices fall, now foreigners can afford to buy more commodities.
In foreign markets, we've seen something similar. I mean, we were able to really take advantage of the rise in Peru. Peru, I guess, rising over the last year or so due to the commodities bull market as well. But we're also seeing a lot of brightness, showing up in Europe right now. A lot of European stocks beginning to break out. As you look around the world in 2017, what other markets look better to you than the U.S.?
Well, pretty much. I mean, most of them. Some of our biggest winners this year have been South America. Look at Brazil. I mean, I'm not a long-term fan of Brazil, but, we got some stocks there up 50, 60, 70% this year, just since January 1st. But I think a lot of the emerging markets, Southeast Asia, the commodity markets, Australia, Norway, I like New Zealand. There's a lot of markets. But then, Singapore, South Korea, Hong Kong, these are developed markets, but I think they're in a much better position than major European markets, or where you still have, there's still a lot of problems in the UK or in France or Germany or, Japan even still has a lot of problems. But there are countries that have far fewer problems. And I think their currencies are going to go up, and I think they're going to benefit from the weak dollar and commodity bull market. The U.S., there's so much downside risk in the U.S. market relative to the real upside potential that there's no reason to be there. But, that's where everybody is buying, right? They're throwing their money at the indexes. In fact, they're not even investing smartly in the U.S. market. They're not even trying to be strategic because most, active managers are seeing net with debt redemptions. All the money is flowing to the index funds. So, people are buying into the most overvalued of stocks. They're not even being selected, but they're doing.
We're in our final moments here with our guest and friend of the show, Peter Schiff. He is a popular economist and author, best-selling author of many books, and the CEO of Euro-Pacific Capital. Peter, in our final moments here, I just want to get your take on Trump, President Trump. What's your assessment of the Trump administration so far? And let's just go ahead and dive into that final question of what do you make of the allegations, these Russian connection allegations that continue to haunt Trump? What's your official stance on all of that?
Well, to me, it sounds like a bunch of nonsense. That's not what bothers me. What really bothers me about Trump is that he's not acting any differently as president than he did as a candidate. He's still trying to be all things to everybody. He wants to be Santa Claus. He doesn't want to take anything away, right? He wants to, I'm going to give everybody great health care and it's going to be really cheap, right? And no one has to, I'm not going to cut anybody's entitlement, right? Nobody's going to have to give up anything. It's just all going to be positive. There's no cost. It's all benefit, right? There's no sacrifice. It's all instantaneous reward, right? I'm going to make America great again, but, we're not actually doing any of the things that are necessary to make it great again. It's not going to be great again just because he wills it, so I want to see some real leadership as far as, leveling now with the voters. Now that you've won, right, now you can be a little bit more truthful and say, look, maybe I campaigned about not cutting entitlements, but, we really got to cut them because, had I said that, I wouldn't have gotten elected. That's the truth. But now I'm elected and I'm going to do the right thing. And here's why we have to do it. And here's the trouble that we're in. And, you can't have a replacement for Obamacare. We got to repeal it. We don't want to replace it at all. We got to repeal Obamacare and we got to repeal a lot of other government programs that don't work and replace them with nothing. We need to replace them with the free market. But that's not government doing anything. That's just government getting out of the way. And that's what has to happen. And it would be great if we can have tax cuts, but we can't afford tax cuts because the government is too big. So if we really want lower taxes, we need a smaller government. And, let's not just cut 30% from the State Department. Let's cut 30% from every department. Or how about eliminating some of these departments? He put ahead of the Department of Energy, Rick Perry, and when he was running for president, he said, I want to shut down I want to close the Department of Energy. Well, then why not put him in charge of closing the Department of Energy instead of running it? Because that's what he was going to do, right? That's what he campaigned he was going to do. Let him do it. And then he could resign once he shut it down. And you know what? Maybe then we can put him in charge of a different department that he could shut down. So, that's what I want to see happening. I want real reforms. The country is in a lot of trouble, and just having Trump be another politician is not the way to solve it. Now, where I am a little bit optimistic on Trump is if we get a major collapse within the next year, maybe we'll be able to blame it on Obama, and maybe he'll be able to do the right thing. The scary thing is if we manage to keep the air in this bubble for another 2 or 3 years, and then it blows up, because then it's all him.
Right.
In fact, I don't like the fact that he's taken ownership of the stock market bubble.
It's bizarre to see that.
When he was a candidate, he said this is a big, fat, ugly bubble. Well, he should stick with that. He should say the stock market's a bubble, not taking credit for it. In fact, when he was a candidate, he talked about these phony employment numbers, and now we get the same phony employment numbers, and he's like, hey, this is great news. Look how good job I'm doing. So he's owning all of Obama's mistakes. And so, I don't want him to own this next collapse, because if that happens, it's going to be President Sanders or President Warren. He's going to be a one-termer, and, things are going to be very, very bad. So all these great things that the market thinks are going to happen. And, even if we get some tax cuts under Trump, you think those tax cuts are going to stay there under President Sanders? And especially if he gets, the Democrats get the Senate and the House, how fast are those tax cuts going to go away? Right? Whatever the government give it, they can take it away. So if we're going to revalue the stock market based on the fact that we're going to have a lower tax, what if the Democrats come in 2020 and they jack the corporate tax rate up to 70%? Who the hell knows? Right? Or what if those idiots just ban profits? You go look at my video I made. There's a YouTube video I made at the Democratic National Convention. I was asking all the delegates if they would support a ban on corporate profits, and they all were agreeing. Yeah, that's a good idea. Let's ban profits. So you just look at my YouTube video. I got over 1 million views on it. I did it during the 2012 election. But so don't get so excited. And meanwhile, if you're listeners to the podcast, if you're investors, if you really want to get involved in the foreign markets, and we're in these smaller markets like New Zealand and Singapore and Norway and Hong Kong, and a lot of stocks that the big players overlook because they're just too big to invest there. Those are the better safe havens. I think that's where the real money is going to be made. And I have accounts that we manage, individual portfolios. I have 5 mutual funds that are proprietary that we run. If people really want to, if they believe my macro thesis and they want to best position their portfolio for that macro thesis playing out, they should contact our brokers at Euro Pacific Capital. It's Europac.com is my website, EUROPAC.com. There's a number there they can call, or they can email us, and we could talk to you about our strategies and how you can participate.
Fantastic. Thanks for letting our folks know about that. You can go to Europac.com and learn more about Peter Schiff's investment analysis and advice. Very well-known economist here with best-selling books and has been talking about this for quite a while. So, Peter, it's very clear that the Trump administration has not changed your philosophy or outlook at all, that we are still facing a grim future. And,
look, we're still on the Titanic. Right, it doesn't matter, who's at the helm, right? We're hitting this iceberg. But about it. The question is, though, which person is best capable to handle the disaster once it happens? And if it was Hillary Clinton, we'd probably all drown. So at least having Donald Trump, when he gets hit with the emergency, okay, forget about the campaign promises. What do we need to do? And maybe he'll listen to some free market people, because he has surrounded himself with a lot of free market people who may come up with free market solutions to a real crisis. Hillary Clinton would have just come up with more socialism to solve the problem. So we would have had no hope under her. So at least we potentially could come out of this crisis better having Trump. But that doesn't mean we're going to avoid the crisis. That ain't happening. That's pretty much guaranteed.
Fantastic. Well, thank you so much for your time, Peter. Really appreciate your insights.
All right. Thanks a lot.
Hey friends, Jerry Robinson here from Follow the Money. Are you ready to learn how to trade the financial markets? Or are you ready to take your current trading to the next level? I want to show you how to trade stocks, commodities, currencies, and options for consistent profits. If you're ready to learn, I'm ready to teach you. In fact, we have created a very powerful trading software and education system that provides you with entry and exit signals on every U.S.-based ETF and stock. Our powerful system allows you to identify the current trend in any U.S.-based ETF or stock with high probability entry and exit ideas. You can use our software on any device, and you'll also get access to ongoing live trading coaching videos. Whether you're a complete newbie to trading or whether you're an experienced trader, you'll love our live video coaching calls held every Tuesday and Friday morning during the live market hours. In addition to ongoing training through our videos, you'll also receive our best trading ideas every evening in our nightly trading report, in which you can log into our website and check out the latest uptrends and downtrends, along with many other high probability trading ideas generated by our system. A lot of people already know how to trade, but they just need a coach. They need someone to help them along. And if that's you, you have found, I believe, the right solution in our trading software and education system. Right now, we're running a very special offer for all new members. Become a pro trader today. Get access to all of our services for only $1. That's right, just $1. Go to followthemoney.com/pro and select our monthly plan and enter March Special into the coupon code section and get your very first month for only $1. Simply go to followthemoney.com/pro, choose the monthly option, and be sure to enter the word March Special, all one word, no dashes, no spaces, and get your very first 30 days of our complete service for only $1. Try it now, followthemoney.com/pro.
Follow the Money Weekly presents your precious metals market update. Here's Tom Cloud.
Hello, this is Tom Cloud with this week's Precious Metals Market Update. The shock overnight of the Netherlands president and the Liberal Party maintaining control of the Netherlands and the pro-Trump candidate getting beat. We're already seeing reactions this morning on Thursday, March 16th, with gold and silver. Silver's up 60 cents since yesterday, and gold's up about $28. It looks like we're going to have the same old in Europe. And, of course, our eyes are going to turn toward France for April 23rd. And Marine Le Pen, the conservative candidate over there, is losing ground. So, right now it looks like nothing's going to change in Europe. The immigration policies, nobody's going to be exiting the European Union except England. And in case you didn't catch it, it has been approved. They can exit. They won the court battle over their Congress-type ruling body. So that's coming up. But basically, now we know that the dollar's been going up based on the expectations that the euro would collapse when the pro-Trump candidate won in the Netherlands, and the possibility of the pro-Trump candidate winning in France. But it's not look like it's going to happen. We certainly can't call it for sure. But what we do know is the reaction of central banks this morning, the purchasing of gold that they've done overnight. They're planning on the euro making a turn sometime in the next 30, 60 days. And when it does, remember, historically, dollar down 1%, gold up 11%. Just go back and look between 2000 and 2012, the dollar went from 126 on the index down to 72, and for every 1% the dollar dropped, gold went up 11%. So we're expecting gold and silver to have a great move the rest of the year. It's already started, it looks like, but we still got one more speed bump in there, and that is the election. Of course, people that are conservatives, we'd still like to see Marine Le Pen win in France, but it doesn't look like that's going to happen, but it could. So we still have to stay tuned for one more month to do that. But I want to expand a little bit on this central bank buying and the huge amount of inflows into gold ETFs. And once again, gold and ETFs are paper gold, even though they drive the markets on shorts and long contracts. You still cannot redeem it for real gold. It's a piece of paper. And we've talked about in the past, you're paying 50 basis points if you're buying an ETF, when you can buy the gold from us and have it stored for only 20 basis points. So you'll give us a call. We can do that for those that do not want to take physical possession of their gold and silver holdings. And there are a lot of our customers that don't want to do that. So we'll be following that very closely. The inflation rate numbers are getting a little scary when you go from 0.02% to 2.6% in 18 months. That's a 13 times increase in inflation, and we're going to continue to see inflation pick up as the debt ceiling argument starts today, March 16th. And we know they're not going to close the government down, and we know there's going to be a lot of fighting over the Obamacare, and there's no telling how that's going to come out. But the debt ceiling has to be raised. And when it does, it's going to create out of thin air another $1 trillion or $2 trillion, which is basically 5 to 10% of the money supply that's been created through the history of America. We're seeing the interest rate yesterday go up 0.25%. Interest now has just gone up another $300 million on the federal budget deficit. And for those of you that haven't looked at the USDebtClock.org, I urge you to go to USDebtClock.org and look at real time what the deficit is, and look in the bottom right-hand corner and see what the real value of gold and silver is based on the creation of money since 1971, just 55 years ago. Silver should be $700 an ounce today, not $17.50. And silver is going to make a tremendous move because these politicians worldwide are not going to let let the economies go into a recession, especially now that it looks like the European Union will stay together. So I'll be buying silver, I'll be buying gold, and there's still a lot of rumors about a gold standard as early as this year. We'll keep you abreast of that as we develop. For those that are looking for a self-directed precious metals IRA, you can call us at 800-247-2812, and we'll help you get a custodian. We can function as your broker and representative and talk about what percentage you want in gold and silver, and you can roll that IRA over from where it is now or maybe part of your 401k. We have a lot of people right now taking loans against their 401k, buying the gold or silver individually, repaying their 401k, the interest. They're winning both ways if the metals market goes up. So that's something very interesting we've seen and many more people doing. So we don't have a lot of information this week, but what information we have is very important. Once again, you can reach us at 800-247-2812. With this week's Precious Metals Market Update, this is Tom Cloud signing out.
Hey friends, this is Jerry Robinson from Follow the Money Weekly. Recently, we have been receiving many emails from our listeners commenting on the great help they're getting from our precious metals expert, Tom Cloud. Gold and silver are excellent hedges against the growing threat of coming U.S. inflation. Who's your gold guy? Make it Tom Cloud. With over 30 years' experience with precious metals, Tom will answer all of your questions. Don't buy your gold and silver through some call center and pay inflated prices. Call my good friend Tom Cloud and speak directly with him and get all of your questions answered. For a limited time, Tom is offering free shipping and insurance on every gold and silver purchase made by our listeners. Call 800-247-2812. 247-2812. And when you do, tell him that Jerry Robinson from Follow the Money Weekly sent you, and he'll throw in that free shipping and insurance on your entire order. Call your gold guy, Tom Cloud, right now for the very best deals on gold and silver coins. 800-247-2812. That is 800-247-2812. All right, friends, and that brings us to the end of our program. Thank you so much for choosing to allow us into your life each and every week right here on this broadcast. And as always, I leave you with a final word this time, just a simple proverb, an old proverb. I don't know who said it, but it's very simple. Health is better than wealth. Anyone facing a terminal illness in the audience today knows that's the truth, that no matter how much money you may gain in your life, nothing can buy back your health once it's gone. So just a gentle reminder to take care of yourself. Go for a walk. Get out from in front of the computer screen or the TV. Go see life. Go smell the flowers. And enjoy your good health while it lasts. And that's just something to think about. Remember, friends, when you want the truth, just follow the money. Have a safe and prosperous week, and we'll see you right back here next time. Until then, God bless.
All of the information contained on the Follow the Money podcast is strictly for informational and educational purposes. It should not be construed as specific investment advice. The views and opinions of our guests and sponsors, including Tom Cloud, are their own and do not necessarily represent the views of FTMDaily.com or Robinson Media Group, LLC. Jerry Robinson does hold an insurance license and at times may offer consulting on life insurance and fixed retirement income products. Follow-up, individualized responses to email or phone requests that involve the rendering of personalized investment advice for compensation will not be made absent compliance with state investment advisor registration requirements or an applicable exemption or exclusion and applicable insurance regulations. Past performance is not indicative of future results. You should be aware of the real risk of loss in following any strategy or investment discussed on the podcast. Remember, never do your financial planning through podcast or radio. It's your money. Be wise. Do your